ETFs are one of the best investing tools ever created, but most investors still make the same expensive mistakes. Some people accidentally create tax nightmares. Others think diversification means guaranteed safety. And some don't even understand what they actually own. So today I'm breaking down the 10 biggest ETF mistakes Australians make and how to avoid them. 10 ETF mistakes you must avoid. First mistake, buying US listed ETFs because someone on YouTube said they were better. Yes, America has amazing ETFs. But Australians often forget about withholding taxes, W-8 forms, and even potential US estate tax issues. For most Australians, ASX-listed ETFs are usually simpler, cleaner, and more tax-friendly. Some investors own so many ETFs, they basically recreate the entire stock market accidentally. You don't need 14 ETFs to feel diversified. Sometimes 3 or 4 quality ETFs is enough. This one is huge. People buy ETFs based on the name alone. AI ETF, Future ETF, Disruption ETF. That sounds exciting. But do you actually know what's inside? Always check the top holdings. You might think you're diversified, but 40% could be sitting in 5 companies. Management fees look tiny, but over 20 or 30 years, they quietly destroy returns. Passive ETFs are usually cheaper. Active ETFs can cost much more. Always ask yourself, am I getting enough value for these higher fees? Lots of investors assume the largest ETF must automatically be the best, but usually it just means it's older. Size matters for liquidity, but don't buy something only because everyone else owns it. Most people think ETFs are always liquid. Not necessarily. The ETF is only as liquid as the assets inside it. In volatile markets, niche ETFs can become very difficult to sell quickly. This happens every cycle. Cannabis ETFs, crypto ETFs, AI ETFs. Everyone piles in after prices already explode. By the time the media starts screaming about it, you're probably late. When you buy international ETFs, you're also making a currency bet. If the Aussie dollar rises, your overseas returns can shrink. If it falls, your returns may increase. Leveraged ETFs are not normal ETFs. These products use derivatives, and many suffer from time decay. They're usually designed for short-term trading, not long-term investing. The biggest mistake? Buying ETFs without a plan. Even the best ETF won't save a bad strategy. You need a reason for every investment you make. ETFs are fantastic tools, but they're not magic. The investors who succeed long-term are the ones who understand what they own, control risk, and avoid emotional decisions. If you enjoyed this video, hit subscribe and I'll help you become a smarter investor without the financial jargon.